Good morning, everyone, and thank you for joining our first Sasfin Asset Managers webinar. By means of introduction, my name is Kuresha Govender, and I'm responsible for institutional business at Sasfin. So, as we know, markets can be very volatile, and so it's quite comforting to have an investment professional who has quite an extensive experience in the market. Arno, our Chief Investment Officer, has been in the investment management industry since 1990 and has a deep institutional knowledge and a vast network in South African financial markets. He's managed funds and portfolio management teams across a full range of mandates, from fixed income to global multi-asset funds at some of our very large asset managers in the country. Today's webinar focuses on mapping out an investment path for income investors in a very turbulent new era of high interest rates. Arno will be unpacking the paradigm shifts within the global context and how we are positioning the flexible income fund and high yield funds, which can be a solution for you and your income generating clients. I'm going to hand over to you, Arno, and you can take us through the presentation.
Great, thanks, Kerry, for that introduction. I think you touched on it right at the beginning, and I suppose we could stop there, which is, there has been extremely volatile times in terms of markets, and in particular across all asset classes, which makes it rather different to the usual story that we touch on when we have turmoil in markets. So I think this is the issue that we're dealing with, that, when we look back, most likely we are going to say 2022 was the year of crisis. And I can tell you now, as a fund manager managing money, this is really what I would like to do to 2022 already, which is to get rid of it and put it in the rearview mirror and move on. Unfortunately, managing money through crisis times, really does speak to essentially tough times as far as returns are concerned. So if you look at this slide where we look at the different asset class returns, really the point that comes across here is that there was not much place to hide. The only positive ones that we got here are South African linkers, South African cash, which barely sort of eked out a real return. It wasn't even a real return in a sense. And yet, across the board, whether you're looking at other bonds, whether you're looking at commodities, property, equities, international bonds, and international equities, it really has just been a one-way story. Those of you that have followed our presentations during the early part of this year, you'll remember that what we spoke about was really around this paradigm shift that we're going through, and that the returns that we are seeing are really indicative of a transition to a new era. And that new era, if we want to sort of start to put a sense to it, I'd be hesitant to say that it would be the inflation era, but what I would say it would be higher interest rates rather at this point in time. So, in terms of this transition, if you look at the drawdown in terms of the total market cap of both the US equity and fixed income markets, the amount of wealth destruction in terms of drawdown on both asset classes really has been enormous. And the drawdown in this chart that you can see clearly here is that, it's 7 times the drawdown in terms of actual numbers relative to the global financial crisis. And again, for those of you, and I'm sure there are many of you that were in markets in those times, and we came to close to a complete systemic meltdown in 2008. And you look at where we are today. This chart really just speaks to the magnitude of the shift that we're going through, and the reason why there has been really no place to hide. So if one thinks about crisis mode, and you sort of think, well, where are the usual sort of safe havens that you would sort of look at? You say gold, traditionally the safe haven, in particular in times of inflation. US government treasury bonds, also safe haven status. Is it Japanese yen, which has traditionally been the safe haven currency? And for those of you that maybe are in a different generation to my own, I suppose, sort of millennials might look at Bitcoin and say, that's your sort of go-to asset. So if you then look at the returns year to date, in a sense, all of these supposed sort of crisis assets or safe haven assets are all sitting in negative territory. And I suppose the naysayers on the cryptocurrency side of things would also have had quite a bit of a shock on that, the sorts of returns you've seen there. So question would be, why have these usual crisis assets not performed? Why have they not been there as a stabilizing force in terms of being an asset that you can turn to in times of crisis? And I think the real answer here is that it's the magnitude of these crises that we are dealing with. So if one goes back now within the last year, let's call it 2 years, starting with the COVID-19 induced supply chain crisis. And, we know what the story is there. The lockdowns created, essentially an economic paralysis, supply chain disruptions. And that was then a trigger for sort of some of these price increases. And I think some of them still persist to this day because China is still in some areas in lockdown as well. And that, of course, then kick-started this cost of living crisis, which, if you go into Europe, US, UK, anything like that, it is the big story at the moment, which is, cost of living crisis. And that really sort of was exacerbated, in a sense, by this whole fiscal stimulus from government side of things, which essentially encouraged increased demand. And for those countries that were sort of pre-COVID, let's call it that, where the economies were fairly healthy, the fiscal stimulus essentially exacerbated the inflation story. And so what was essentially went wrong, I suppose, in a sense, was central banks who, at the beginning of the recovery, were sort of patting themselves on the back, and governments were patting themselves on the back in terms of getting, out of the sort of COVID-19 sort of lockdown phase. And really then a sort of stepped, if you want to put it like that, in being too slow to respond to that initial inflation surge, which, yes, would have been transitory, and then became more entrenched into more structural inflation. And so they have essentially are now dealing with, and this is not just the Fed, but you're looking at central banks in most of the developed world who essentially are now sitting with a credibility crisis in terms of what do they do? Do they hike harder to get rid of this structural inflation, or do they sort of look at the economy and start saying we need to start pulling back? And I think if one looks at the minutes of the Fed meeting that just came out, then if you read between the lines, almost in a sense here, is that the cost of doing too little and allowing inflation to become too persistent was deemed to be too high, rather than essentially backing off and looking at the economy. And then, of course, in Europe, we have an energy crisis as well. And we know the story there around essentially the Russian military strategy, which really did expose European energy dependencies. And so, of course, we know that this is now leading to an acceleration in terms of a shift towards renewables, finding alternate energy sources, whether it's gas or oil, rather than Russian. But the fact of the matter remains is that, there's no quick fix to that, and that is going to persist, and they are going into a Northern Hemisphere winter. And so we can start to see that these are starting to lead towards essentially some of the issues that could become political crises. And in particular, the first one that we're starting to see, in fact, is sort of in the UK, where they had a change of leadership as well. Over this period, with the backdrop of all of these other crises, as the backdrop that could shift things back to or out of crisis mode, and where you could start to see markets rally. I would hesitate to say that probably the single biggest catalyst for a market run on the upside would be, for example, if Vladimir Putin were to be deposed as leader of Russia. And there was a change in strategy around that. Certainly you would see a significant shift in markets, believing that we would maybe be able to get back to some sort of peace agreement between Russia and Ukraine. But I think, beyond that, what I'd like to posit is on the other side of things is that if things keep going as they're going at the moment, then what we have here is a set of ingredients, which I do not want to be a doomsayer, but essentially what it does speak to, in my mind, is the potential for a debt crisis. And by that, what I mean is essentially the lack of credibility from central banks, higher interest rates in essentially highly leveraged conditions within certain segments of the market. And in particular in the UK is where we're seeing this play out in real time, where pension funds essentially were subject to margin calls and had to start selling into a weakening market, and that exacerbated to the extent that the Bank of England had to step in and provide a backstop to a spiraling bond market. And what they've come out now is quite a hardline stance to say that they have only a couple of days. I think it's actually tomorrow, where the pension funds have to essentially get their act together. And so there's certainly definitely a potential there for severe market disruption. In the UK, it is already a debt crisis to the extent that the pension fund industry is already sitting with this sort of volatility. So certainly from that perspective, debt crisis then becomes something like where you start seeing increased defaults, where it's the higher interest rates for longer, which is exactly what the Fed is starting to talk about in these sorts of environments. So, but I think let's just reevaluate things before we come back to this. The one is this inflation story, which is, yes, American inflation has been at its highest level for 40 odd years, and we know that the medicine that was taken in 1980, by comparison in terms of those levels, was the Fed having been forced to hike rates to around about 20%. You can see the peak there in the inflation story, looking at over 14 odd percent in early 1980. And then look at what the Fed had to do in 1980 to get inflation back under control. They pushed interest rates up to 20%. Now, there's one other lesson here, which is that you can see, if you go back to 1980, a very clear spike upwards, and then almost immediately they pulled back on interest rates, and then were forced to hike again back to 20%. And this is the lesson of today, which is that the Fed is taking very seriously, and it is even in their minutes, which is that historical precedent shows that when you are fighting a severe bout of inflation, if you pull interest rates lower too quickly, the inflation becomes entrenched. So I think the real message here is that we are moving into an era where central banks will have to keep interest rates higher for longer. Why is this relevant for us today? Well, in the sense that it's going to probably create some sort of recessionary conditions in the States and across the world. But as income investors, we should be saying, well, this is going to be great, because you then have access to even higher interest rates. And eventually, if the central banks do manage to get inflation back under control, you'll be able to lock in some of these very high interest rates over a long period of time. Some of the positives around inflation: oil prices, which was one of the drivers, especially in the first half of this year, have come off their peaks. Granted, what I would say here is that it's not to say that there's no possibility of this actually sort of going upwards. We've already seen some news coming out of OPEC that's speaks to this as well. So I wouldn't discount the fact that the oil prices sort of start stabilizing at these sorts of levels, and with risk to the upside. Having said that, if we do move into a severe recession, almost certainly oil prices will collapse as well, and then exacerbate the sort of the shift towards a lower inflation environment. I think the point I made about the credibility around central banks is probably indicative in this one. I know it's a little bit complicated, but let's just go through it. It's the Fed funds forward curve at various dates. So you'll see that, for example, the green line, April the 7th, 6 months ago, that is where the market was essentially pricing the Fed fund rate to get to. So let's call it, in a sense, this is where the market expected the Fed to get to in terms of the hiking of the Fed funds rate, up to 3.2%, and then flat out for the rest of 2023, by mid-2023. And then you can see the history of this is that, it's blown out completely. It's gone up to almost close to 5% that they needed to hike to. And then more recently, sort of coming back to a slightly lower level, around about 4.5%, with a tapering off into 2023. If you read between the lines again, as I said, where they've said higher rates for longer, I suspect that downward slope is going to get priced out fairly quickly. But I think the point here is that the communication of central banks has been difficult, granted, but it has also been probably flawed in terms of the messaging. And this has not helped markets. And we've seen this again in the returns that we've spoken about as well. So we essentially have sort of almost two camps here, in a sense, about scenarios. The one camp here is the one which says, you know what, bad news is good news. And the way that this rationale works is, poor economic data means that the economy is going to be going into recession. Inflation will then probably fall faster than expected, so the Fed won't have to hike too high. And then they'll actually be able to start cutting rates sooner, and that's going to be great for markets. So when you see poor economic data, you should be buying the dip. That's sort of almost been what we saw in early October when we had that brief market rally, which was that the economic data was showing that, there's signs that maybe inflation is going to start falling because the economy is, the first signs of weakness are starting to come through. I don't think that is probably the scenario that we should be following at this stage, given the backdrop of those multiple crises. I think that's the essence here, is that none of those crises necessarily are going to be going away over the course of the next 6 to 12 months. So I think that is the issue that we have to really deal with here. The other camp is that what, bad news is good news. Bad news is bad news, or maybe another way of saying that is that this time is different. And I would probably, in terms of the way that the Sasfin team is looking at things, is that we are in a different era. I think we're not going back to this zero interest rate environment that we had from, let's call it, post-global financial crisis. And so certainly our sort of view here is that central banks have been underestimating the inflation problem. Some of the triggers to higher inflation still remain. So, for example, as I touched on the oil price side of things, the geopolitics, we don't have no certainty as to whether Putin may be backed into a corner and starts to use tactical nuclear weapons or anything that line, and essentially an escalation of that. We can't say that for sure. Again, we know that that sort of mutually assured destruction sort of approach is what has guided sort of military doctrine over the last number of decades, but there's no guarantees that necessarily continues. So our sense here is that the central banks will most likely have to hike by more than expected and have to keep it there for more than expected. And this is probably a bad news scenario that needs to still be priced into markets. I think they're starting to get there, but I think at the same time there are still these two sort of camps. So if we then look at the US Treasury market in terms of, let's call it, the global capital markets, US Treasury market being the deepest bond market in the world, and you can clearly see the sort of the story that we're talking about here. So in the beginning of this year, we still had this sort of narrative that was in the market that the inflation is still transitory, and that yes, it might need some mild interest rate increases, but nothing too severe. Of course, February, when sort of the next crisis sort of was initiated in terms of geopolitical side around the oil and the energy story with Russia invading Ukraine, essentially the market realized, and the Fed started to realize, that they got it wrong. This is not going to be transitory. It's not going to be temporary. It's actually going to be more permanent. And you can see what happened is that the bond market started selling off pretty severely in the middle part of this year. And then, of course, the oil price responded as well, but peaked in June. And that is exactly when the US Treasury bond market peaked as well in terms of yields. And essentially what the oil market sort of really realized was, is they bought into this narrative then that the Fed is going to hike rates, crush inflation, cause a recession, and hence the fall off in demand. And so you saw those oil prices coming off quite severely. I think that the big sell-off that we see now over the last month and a half really sort of has been the fact that it's the sort of move towards this, let's call it this scenario 2 camp, which is that the fight against inflation is probably going to take longer, and the Fed must not make the mistake of cutting back rates too quickly. So I think that really is the bottom line narrative. In the UK, this is really sort of essentially a politically driven side of things, but their bond yields have moved from, sorry, I went too quickly, have moved from around about 1% and post-COVID was, close to the 0% side of things, to sort of over 4% in terms of a 10-year bond. Now, if you just take that as a year-to-date move, so in other words, just for 2022, and you'd bought your 10-year bonds at around about 1%. If you then worked out the value of what that bond is today, you would have lost 25%. And this was in a market that's considered to be a relative safe haven as well. So I think this really just speaks to the fact that, pension funds in developed world, generally speaking, tend to have had a higher bond exposure than what we are quite used to here in South Africa, where we would typically use that sort of 60-40 type split, the traditional balanced approach. Pension funds in the Europe, UK, US tend to be essentially sort of almost liability driven investments, so very heavily involved in the bond market. When you've lost 25%, it becomes crisis. So I think really sort of a lot of work to be done there. And I think it's not over yet necessarily in that particular market. In South Africa, if you then, factor in the rand, you look at the oil prices that have come off, it does seem as if some of the drivers of inflation are starting to come off, some of the food prices as well. And bear in mind that in the South African context is that our inflation is not driven by a demand-led impetus. It is really about where we are price takers, whether it's the oil prices, whether it's the food price side of things. So very much a case of it's not because there's been excessive fiscal stimulus in South Africa. In our bond market, of course, we've seen a number of shifts as well. So that first sort of half of the year when US Treasury were selling off, we also sold off as well. We were already at relatively cheap levels relative to our historical past, but in particular, June, July, we saw that big sell-off when essentially this recession scenario started to gain traction. And really what we had then was a case of the market saying, well, then emerging markets are probably going to be hit as well. But then essentially we had, getting to 11.5% on 10-year bond yields in South Africa, and the buyers started coming back. But more recently, there's this narrative that perhaps it's going to have to be higher for longer. And so we sort of back above 11% on 10-year bond yields. Now, again, this is the issue here, is that in terms of timing, is that these levels are very attractive, yes. But if you had already bought them when it was at that 10.5%, you would have suffered, some capital losses, probably about 3% from, let's call it, the middle of August to the end of September. So having said that, that is really sort of the backdrop to what we are sort of really trying to get to. And in the South African context, what's priced into markets, these are the implied rate moves over the course of the next year or so. And really it speaks to the fact that the SARB is going to hike for another 2% from current levels. Now, our team is of the view that that's probably going to be too aggressive. Already our economy is very weak. The most recent numbers that we sort of see from various analysts are pointing to, over the course of the next 3 to 4 years, almost certainly growth in South Africa is going to be sub 2%. So certainly, it's not going to be demand-driven inflation that we speak of in our country. So the forecasts in terms of inflation do show that we're going to peak fairly early and base effects start kicking in. And certainly leading into 2023, we should have some more positive news, which would hopefully enable us, or the SARB anyway, to be able to peak out on rates earlier than what potentially the Fed even does. I touched on the growth story. Even the National Treasury's own forecasts point to a rather dim growth outlook, and certainly that is the backdrop. There's no sign that any policy shifts that are in the offing as far as economic policy is concerned is going to be a catalyst for South Africa getting into a high growth environment, which is what we've seen, for example, in the US, where you've got high inflation and your growth is pretty good at the same time. And that then sort of starts feeding through into wage inflation and so forth. If I just touch on one other factor, which is really on the radar screen, normally it should be a few, but I think really it's China. And really it sort of speaks to the fact that, South Africa's economic prospects are very tied to China. And so what we're looking at really is, how do things play out as far as China is concerned? And, if I sort of then use the Chinese property market side of things, I've actually got the wrong title here, the US gas futures price. It's not. It's the China Property Developers Bond Index, and really sort of they've lost close to 60% since the peak, and really speaks to the fact that there are some significant shifts within the Chinese economy and no clear end in sight for them as well. So certainly from South Africa's perspective, there's nothing really there that is a catalyst for us to be in a sustained bond market, whether it's on the equity space or on the bond space. So what are some of the key outcomes here? One is that the inflation dynamics might require a sustained hiking cycle, and that's, of course, speaks to the recession and more equity market weakness. Oil prices are already discounting a recession scenario, but we've got the gas prices as a separate, which does mean in the European situation is that cost of living crisis persists. China, as I mentioned, is in terms of their growth phase and linkages to South Africa in terms of commodity linkages, really does speaks to a global risk off and reinforces that as well. I think the market's too pessimistic about the extent of the SARB interest rate tightening. I've touched on that. And then really, if you look at South Africa, we have a lot of systemic failures. There are some pockets of excellence, but it does then speak to a continuation of higher bond risk premiums. So yes, bonds are cheap in South Africa, but they're going to stay cheap. Having said that, it doesn't mean that with all of this bad news around, is that it's bad news for income investors. In fact, what we think is that there is most likely going to be a range trading environment over the course of the next 6 months, unless we have this debt crisis type of environment that starts to come through, in which case the potential for further shifts upwards would certainly be there. And I'm going to come back to that as well. And then socio-political upheaval in times like this, I think they are probably underpriced. We're seeing this in certain jurisdictions, and so certainly it's something that you have to keep at the back of your mind as well. So what does this mean then really sort of for portfolio strategy as a sort of a broad, paint strokes? In South Africa, we are already starting to reduce our inflation protection as we've seen the sort of inflation starting to peak out. Why? Because we're starting to see these nominal bond yields offering better value. And certainly you have higher liquidity than the inflation linkers as well. Floating rate exposure is interesting, will continue because it's going to remain as high interest rates locally. They will continue to provide high income yields. And of course, a floating rate exposure does actually provide you with a hedge against a further inflation shock, because if there was higher inflation and the SARB had to hike further, if you had floating rate exposure, you would benefit from that as well. Here's one key ingredient here in terms of strategy. No need to increase exposure to credit in the SA market, and in fact, even globally. If we go into debt crisis, whether it's a sovereign level or we see recession risks rising, you will see increases in defaults, you will see rising credit spreads. And so certainly in our mind, there's no need at this point in time to increase exposure to credit, because the yields you're getting at this stage in the South African market are already compensating you in a real basis at a very attractive level. In this binary sort of scenario world, the ability to shift your strategy quickly. So if we went into, for example, if there was some sort of contagion around, if I use the UK as an example, if there was some contagion around that, what you need in a fund is the ability to shift your strategy quickly. And that does mean a distinct focus on the liquidity of your underlying assets. So I think that's a key factor in terms of as you build your portfolio strategy as well. It's highly unlikely that we are going to see sustained gains in bond yields unless we saw a significant shift to the positive in the global inflation outlook, not the South African one, in the global inflation outlook. I think that's a key perspective that we have here. And then, of course, the strong dollar will keep the rand on the back foot for the time being. Having said that, we don't think that there are South African idiosyncratic issues on the table at the moment, which point to a blowout in the rand at this stage. There's a lot of, let's call it dollar strength that is built into the cake at the moment. And so certainly for the time being, it will be there, and especially whilst the Fed remains on the sort of, with their foot to the pedal on the interest rate side of things. But as soon as you see a turn in inflation, I suspect you'll see a fallback in terms of the strong dollar narrative. Okay, so let's go onto the funds. How do we then work a portfolio strategy and for income investors within this sort of environment that I've created? And so certainly, the two funds that we sort of really position here are the flexible income fund and the high yield fund. So the objective in the flexible income fund here on the left is to offer essentially a bond-like return, but with a lower volatility. Where does this then come from? What do we do within the fund? So the do's and don'ts. Firstly, we only stick to fixed income. We don't add in anything else here. So it's asset allocation calls, it's duration calls around macro and micro events. The sorts of risks that you're going to find within the fund are interest rate risk, credit risk, term risk, and liquidity risk. And it's a blend of that. And I'm going to show you this in a little bit more detail a bit later on. What we don't do here, equities, property, pref shares, currency risk. And the reason for that really goes back to this point on the left here, which is lower volatility. Because if you're going to be including equity risk or property or pref shares or currency, you're introducing a different level of volatility. So our objective here is a very clear one of, yes, we want to be in the bond markets, taking advantage of these high bond yields that we're seeing at the moment of 11% plus in, let's call it 10-year bond yields. But we want to gain those sorts of returns, or that sort of return, but with lower volatility than what you see in the all bond market. The high yield fund is essentially an income provides a monthly income with a very low capital volatility. So you would understand then the two funds here in terms of their difference. Very much a floating rate focus here, also fixed income as well. We don't do the equity, property, currency risk side of things as well. And the point here is that essentially these two funds are income solutions. One of them looks through the cycle and is able to take essentially higher risk in terms of duration and so forth. And hence you will see some more volatility within it. Whereas the high yield fund wants to be able to benefit from current high short-term rates, right? Because it's generally a short-term focus, either floating rate focus side of things, with very low capital volatility. So for those investors who are looking for a solution where they don't want any capital volatility, but want to have regular monthly income, high yield is the place to go. And, really sort of satisfies, quite a niche in that respect. Whereas the flexible income fund is for those investors who essentially want to, play in the bond market and look through some of the volatility and are able to sort of have a 3-year type of a horizon within the fund. So in terms of performance, if you go back to those investment objectives, so you'll see that over various periods, year to date, for example, 1 year, 2 years, you'll see the return in the 1 year space, for example, relative to bonds. So and relative to the grey bars in particular, so the domestic bond market, is that over all periods, we've been able to deliver that return that we're looking for, i.e. the bond-like returns. But again, if one looks at the one-year number, 4.7%, and we can pat ourselves on the back and say, well, there we go, we got the bond-like returns, is that, they remain fairly poor, because the point I made earlier is that in terms of timing over the last year, it's essentially been a big global bond sell-off. So as much as what we can be reasonably proud of accomplishing our return objective, they haven't delivered the sorts of returns over these shorter periods, that are real returns. But having said that, again, this is looking through the cycle, and we have to start positioning for what comes going forward. And then in a high yield fund, again, if you look over these periods, over relatively short periods in terms of this sort of essentially the short-term cash markets, you can see it's done phenomenally well. It's delivered on its mandate. It doesn't have to take duration risk. You can see the one-year number, 7.1%, relative to the bond-like return of around about 5%. So again, if one then looks sort of over longer periods of time, you'll see that the flexible income fund over long periods will outperform the high yield, or should. But over a shorter period of time, when you have a negative bond market, it will tend to underperform those funds. Then we come to the risk angle. And we asked the question in terms of the flexible income fund, right? So we delivered on the return objective. What did we do relative to the risk or the volatility? So if you look at this chart, you can see the all bond index, rough volatility there around about 8% per annum, whereas in the case of the flexible income fund, we're sitting around about half that, around about just over 4%. So I think we can tick the boxes then in terms of the investment objective of bond-like returns, but with lower volatility. So I think, that is what we really are trying to do, and to ensure that as a solution, that we stick to our knitting as far as doing that is concerned. And then again, you'd probably then say, well, okay, but how did you do relative to peer groups as well? Because, there are a lot of other solutions that are out there. So if you look at it on this basis, and you look at essentially the risk return side of things, there's sort of two camps, if you want to put it like that in a sense. The one is the one on the right-hand side. You can see the grouping in terms of risk return. And those are the guys essentially who are out there who typically would be including things like offshore, property, pref shares, equity risk, etc. And you can see the result there is that it doesn't necessarily then translate, by taking those additional risks, or volatility, should I say, doesn't necessarily translate into higher returns. And then you get to the grouping on the left, which are essentially these sort of cash plus type funds. And you can sort of very clearly see that it's significantly lower volatility, but then generally speaking, you'll see over time, through an investment cycle, which is what this is really showing, is that the trade-off would then be your returns relative to that. And what we've found is that with our flexible income fund, is that, by managing it in the way that we have, we've been able to essentially be a bit of a hybrid between these two. Is that at the times in the cycle when you want to be at capital preservation, then you are there. Other times when you can be taking risks, then you are able to take advantage of that. And then just in terms of the high yield fund, again, in terms of where its positioning is concerned, amongst those sort of, let's call it the cash plus type funds, you can see that in terms of the volatility, all of them are fairly low. But again, I think been a very pleasing performance in terms of steering its way through this environment. And essentially, it's got to be quite a forward-looking fund in the sense of positioning yourself such that you're able to take advantage of higher interest rates as and when they appear. And this comes back to also managing your liquidity risk, which I'm going to touch on a little bit later. So just in terms of the positioning around this is the weighted average yield of the flex income fund at the moment, around about 9.6% at the top there. And then you can see the duration sitting around about 2.4, which essentially, again, just a reminder for those of you that didn't get your CPD points previously, duration, the number is, if the rough rule of thumb, if interest rates move by 1%, that's the capital movement that you'll see. So if bond yields move up by 1%, this fund would tend to see a capital loss of around about 2.4%. Or alternatively, if yields drop by 1%, you would see a 2.4 capital gain. But bear in mind, your underlying income is going to be sitting in the region of probably around about 8.5 to 9%. So remember, you have to add those two together as well. I run through the detail of the split within the fund. I'm going to come back to these as well. Then in the case of the high yield fund, you can see a slightly lower weighted yield of around 8.2%. And then very significantly, the duration of the fund is 0.2. So you can very clearly see that the two funds are distinctly different and cater for two different types of risk appetite. So if you are of the belief that we are going into this, let's call it a crisis mode and even a debt crisis, and you had very strong conviction about that, then probably you'd want to be in the high yield fund. Naturally, what we would do is if we were going there, we would probably be cutting duration further in our fund as well. But having said that, this would then be a good safe haven fund to look at. And again, just to sort of emphasize, you can see in the middle, a very big focus on the floating rate component of the fund. If I just go back to the flexible income fund, you can see only 42% in floating rate. So it's not as if they're completely, there are overlaps in terms of that, but again, it very much speaks to the fact that, we want to be able to essentially, look through the cycle on the flexible income fund. There's the weighted average yield on the flex income fund. You can see it was sort of starting to fall off, and then the big sell-off that we've seen and rising rates. Now we're starting to see essentially a shift backwards towards sort of the almost close to the double-digit type weighted average yield within the fund. In terms of duration, you can see that sort of the red bar really was the low point in duration, and subsequent to that, really sort of there's been this up down, which really speaks to the fact that this is an active duration fund, where we really what we've been focusing on is making active duration calls within the fund at the appropriate time. When you see sell-offs, making use of it. When the bond market rallies, bringing the duration back down again. So again, that really does speak to the fact that it's actively managed, and B, if you look at the average duration, generally about half of that of the all bond index, and that speaks to that low volatility story. Okay, so then let me delve a little bit deeper into the strategies, and I've given you essentially the backdrop here of higher bond yields, higher short rates in terms of central bank rates, i.e. the official rates. This is the environment that we're going to be in. And certainly in that environment, you would probably say if there are increased risks within the system, the one thing that you want to be able to see within your fund is that you are starting to cut back on certain risk. And so certainly if you look on the right-hand side here, where we allocated each sort of entity within the fund to a strategy, the predominant component of the fund in almost 2 odd years ago, really was a yield focus. And that was the right thing at the time. That really spoke to the fact that you had a zero interest rate world. In order to be able to generate that additional return, it made sense then to focus on yield with a component of low volatility. But of course, we know the world has changed and is continuing to change. And so you can see the subsequent evolution of the fund in terms of introducing more multi-strategies within the fund to take into account the realities of what we're dealing with in terms of the market at the moment. Today's market, vastly different to where we were in December 2020. So you'll see inflation protection in September, where we'd already pushed that up to 10%. We're already starting to cut back, as I mentioned earlier. There's the duration call, there's a roll down effect, and there's a yield component to the fund, which is lower than what it was before. And then there's a low volatility component of the fund. And interesting, if you then look at the durations of the fund as well, in terms of where we were, so you can see quite distinct differences in terms of duration. So again, that speaks to the active management around duration for this fund. In terms of the issuer type exposure as well, I spoke about the fact that you need to be able to essentially look at the market and sort of make a judgment call as to what's appropriate. And you'll know the story that Sasfin has about, taking the appropriate risk at the appropriate time. It's not about saying we don't want to take risk. Sometimes there are times, I will admit, and I can distinctly remember 2008, where I wanted to have no risk when there was a systemic meltdown. But that's a different era. Let's park that one for now. So we're looking at it today, and we start saying, the return that you're getting out of credit is, in a sense, in South Africa, the return that you're getting is not compensating you for the risks that potentially lie down the line. And so certainly there's been a clear reduction in terms of credit risk, or an improvement in the credit quality of the fund. Then I spoke about liquidity and the fact that we're moving into an environment where there's a very high degree of uncertainty. Those two camps that I spoke about, where as much as what I can have conviction, the market can make you look like a fool at times as well. We've all been through this. And so certainly the ability to adapt quickly is quite key in an environment like this. So certainly from that perspective, what I would want to be able to see if I look at a fund is to say, in an environment like this, how much liquidity do I have, and the ability then to be able to change the strategy if I am proven wrong or the data proves you wrong. And so certainly if I go back to, for example, December 2020, you can see there that in terms of the underlying liquidity, about 70% we deemed would probably have taken about 3 weeks or longer to essentially shift. Whereas today, you're looking at, only about a third, and very high liquidity in terms of, 1 to 3 days. That's looking at, over half the fund I can shift essentially within 1 to 3 days. So that really speaks to the fact that, preparing the fund such that, we don't have a perfect crystal ball here. We have scenarios, and if they play out in certain ways, we implement certain strategies, we take certain risks. But I think, as things play out, then we need to be able to essentially be active managers. Having good liquidity is key to being an active manager. Then in terms of the high yield side of things, I could just maybe point you out being sort of the high yield side of things. It's not just about then going out and buying corporate credit and so forth. So certainly here I can speak to the fact that if you look at the top component here in December 2020 in terms of AAA exposure and AA plus, and then you look on the very left in terms of where we were. So certainly there, you're looking at close to 60% sitting in the upper echelons as far as credit risk is concerned. And I'll importantly make the point here is that it has not sacrificed, in terms of that, it hasn't sacrificed the yield on the fund. And so certainly if one looks at the performance within the fund, it bears up that strategy. And then again, just in terms of the underlying issuers, again, if one looks at essentially on the right-hand side, December 2020, very little in terms of government risks, so certainly some senior unsecured and some subordinated side of things. And then if you look at where we are today, government guaranteed, essentially, government risk and the senior unsecured, making up, close to 60% of the fund. And again, the point made here is that it hasn't been at the sacrifice of yield within the fund, because it's about being smart with what you're doing within the fund in terms of those structures. And then again, in the high yield fund, again, in as much as what it's a low volatility fund, and hence, you don't need to change strategies as quickly because it's essentially mostly a floating rate strategy. Again, a distinct improvement in liquidity. You can see 70% on the right there, would have taken over 3 weeks to liquidate if required. Now we're sort of sitting at significantly better liquidity levels as we sort of speak at the moment. So again, that really sort of, informs the views as to where we are. And then lastly, I would sort of say, what I've painted for you here really is a picture here in terms of a potential scenario, which is a good scenario for income investors, but comes with risks to the upside from that perspective in terms of the crises and the potential default scenarios that can come out of it. What I've shown you is that we've been able to, through different environments, been able to deliver those returns with the right volatility profiles. And then, significantly also being able to do it where we have been extremely competitive relative to peers. And I think that the other side of things really comes out of this chart here, which is really then saying, well, there are other funds that do similar things to us in the sense of offering a income solution. But I think really what it shows here in terms of correlations is that because we do things in a slightly different way, is that we tend not to be highly correlated with such investors. And you can clearly see in the green numbers, our correlation relative to those peers versus the numbers on the right hand, which tend to be higher, and they tend to be sort of more grouped. And they could be because those are guys that would be sort of using, for example, property or offshore, whatever case might be, whereas we don't do that. So I think from that perspective, I'm going to park it there really in terms of the presentation side of things. I think really, in terms of the summary side of things, I hope I've been able to paint a picture of in this income space is that this is what we probably expect to happen. It's a great environment for income investors if you can look through the cycle. If you can't, then there's the high yield fund that will carry you through that cycle until such time as you believe is the right time to be able to take advantage of those higher bond yields. So essentially really sort of what we have is a fund for all seasons. You can even combine them, I suppose, but that's not a sales job from my side. I'll leave it rather to Martin and his team to sit with you guys. So I'm going to then end off there and then see if there are any questions that need to be answered.
Yes, there are a few, Arno. So we have a question around the retail savings bond offering 11% over 5 years. Is that safe? Is it a good option for caution investors?
Yeah, I mean, retail, those retail bonds are pretty good. And again, what it speaks to then is having a long horizon. So certainly, from that perspective, they generally tend to be correlated with government bond yields. I mean, that's really sort of where you sort of looking at. I think the thing would be here is that if you're going into those sorts of investments, and they're not bad investments, right? Because essentially it's government guaranteed, right? And 11%, we know that's a good return. The only thing that you would have would be if there were to be a crisis scenario globally, then you would say, well, is 11% good then? If you think over 5 years, essentially we'll get through this, then yeah, I mean, 11% is going to be a decent return. And, certainly that's the sort of return that you would get, out of a 10-year odd bond as well. So certainly, it is attractive, but liquidity is going to be the issue. So again, but there's nothing inherently sort of wrong for that. And as a portion within a fund or a client's portfolio, I can't argue with that, yeah.
Okay, if we have further interest rate hikes, would money market not be a better option rather than for income funds?
Yeah, so that's a good question. So generally speaking, we all know money market funds tend to invest in short-dated fixed income assets, and they tend to be fixed rate. So certainly, you would buy TB bills or NCDs offering you 5-6%. And in the case of income funds, the ones that are exposed to, for example, bond markets, like the flexible income fund, would, if you had, I won't say rate hikes, but I'm going to come back to that, is if you had bond yields moving higher because inflation is more of a problem, well then yes, you might like that, as what we've seen. So certainly from that perspective, you'd say, money market might be a better short-term option. Having said that, as the question is around interest rate hikes rather than bond yields, right? So bear in mind is that an interest rate hike generally is reflected almost immediately in a floating rate asset. So in the case of the flexible income fund, we've got 42% in floating rate notes. So immediately, if the SARB were to hike rates, 42% of the fund, if they hike by 75 basis points, would suddenly be now earning 75 basis points more. So actually, most of those income funds would then have a benefit. In the case of the high yield fund, though, with a over 70% exposure to floating rate notes, is that would even benefit more. So further interest rate hikes, high yield fund is your answer, without a doubt. And you can go and look at the numbers you can go and compare high yield fund against money market funds, and you'll see that we've outperformed them over all periods.
Okay, in your opinion, should investors remain invested in the USD bond funds, having undergone huge capital losses year to date?
Sorry, the question is, should they remain invested in that?
Yeah, should they remain invested?
Okay, that's a tough one because it basically says, where's the US bond market going to? So I'm going to approach it from two angles. The one would be if you were an American investor, and the other one was if you're a South African investor. So if you're a South African investor and you're investing in US dollar bonds, you're getting the benefit of the currency as well. So you would have had, given that the rand is depreciated, you would have an offset of those capital losses. And I think the point about the capital losses is that 100%, as I showed you in the case of the UK gilt market, where year to date, if you'd invested in a UK 10-year bond, you would have lost 10%. If you hold it, okay, so let's call it, so for a year, you would have lost 25%. But if you still hold it to maturity through that time, you will eventually then still get that. You would have bought it at 1%, right? You will get your 1% per year over the 10 years. But I know what the question here is that, in terms of timing, I don't think that we necessarily have seen the top in terms of US bond market. So I think there is a risk that it could potentially go a bit further. But unless it becomes, a serious geopolitical shift, which causes oil prices to go back above 100, another inflation shock, in other words, is what I'm speaking about here. In which case, then the expectations would be that the Fed would have to hike rates even further. Bear in mind, 1980, inflation was at 14, they pushed rates to 20. So the real Fed funds rate of 6%. Today, if you think about where we are at 3.5% for Fed funds, and we're looking at a peak of 4.5%, inflation's at 8.5%. So the real Fed funds rate is still negative. So again, if inflation persists more than what is currently expected, there is definitely still a potential. So I would say timing wise would be, I wouldn't have a high conviction call on that one.
Okay, this is more a comment and also kind of a question. Bonds and interest rates are both offering high returns. Isn't this unusual given that they generally have an inverse relationship?
Okay, yeah, that's also an interesting question because the way the cycle works is something like this, which is that this interrelationship between short-term interest rates, i.e. what the central banks determine, so in South Africa, it's the repo rate, bond yields, which are essentially debt instruments issued by, let's call it governments, but there's corporates as well, and then that's spread over a term, and then you have inflation, the inflation rate. So when you look at bond yields, the government bond yields, not the interest rates, right? Then essentially there's a term premium. So which is that if you're going to put your money down for 10 years, you want a higher return because of risk. Inflation could be higher, the government could go bankrupt, et cetera, et cetera. So you need, higher yield. The short-term interest rates are determined by the SARB in South Africa's case, or the Fed, or the Bank of England. And that is essentially there to target inflation. So they would look at it and say, inflation's higher than our target, and we are now going to start pushing interest rates up in order to slow the economy down such that inflation gets squeezed out. Now, the bond market would look at it and say, so if the SARB is hiking rates to bring inflation back into the target range, that's great, which means that longer end bonds would actually rally in the sense of saying, well, that means inflation risks are going to be reduced in the future. So that's the general relationship. Having said that, if you look at what's been going on in the US, where you've had Fed has been hiking rates and the bond market has been selling off, why has the bond market not rallied when the Fed's hiking rates? And the answer is that the bond market is telling you that the Fed is underestimating inflation. And so they're saying you need to keep going. That's the bottom line at the moment.
Thanks, Arno. That looks like that's all the questions we have. I am going to remain the eternal optimist. I'm going to go with your scenario 1. Bad news is good news. Thank you guys for joining our first webinar. If you do have any more comments, please use our contact emails and send us the questions for Arno. If you have registered and sent through your ID number, we will be sending you through CPD certificates post this webinar. Thank you all. Take care. Cheers.
Great. Thank you very much.